Hello, my name is Evan, and welcome to Evanomics 101, your number one source for everything economics. What if I told you one of the fastest growing parts of our financial system is also one of the least understood and potentially the most dangerous? Private credit has been exploding in recent years and quietly becoming a backbone for corporate lending. But with the growth comes some serious concerns. So in today's video, we're going to break down three key topics around private credit. Number one, what exactly is private credit? Number two, the hidden risks building up inside the financial credit system. And what this could mean for the broader economy if things possibly go wrong. But before we jump into the video, I have a quick favor that really helps grow the channel. If you enjoy content like this, hit the like button, share it with someone who needs it, and subscribe so that you don't miss what's coming next. I've got a lot more content like this, and it can help people kind of understand economics a little bit better, and subscribe and make sure that you stay ahead. All right, let's get into it. So what is private credit? Private credit refers to loans made by non-bank institutions. All right, think about investment firms, private equity funds, asset managers, those type of businesses rather than a traditional bank. All right, instead of going to a bank for a loan, companies, especially like your mid-sized or larger companies, are increasingly turning to these type of private lenders. So you have banks on one side, and you got businesses on the other. Think of it like that, all right? Think of it as businesses loaning money. I think you can kind of see where we're going, or can kind of see where the problem may come when you have businesses starting to loan money, or who have been loaning money. So the next question is why? So after 2008 financial crisis, banks faced stricter regulations. They made them more cautious about lending, especially to riskier borrowers. Private lenders stepped in to kind of fill that gap. And they didn't just fill it, they scaled it massively, all right? We're now looking at a market worth over trillions of dollars, with firms offering everything from direct loans to distressed debt financing. So think about it from a business owner perspective. Private credit can be attractive. If you can get it's faster way to access capital, more flexible loan terms, fewer regulatory hurdles. For investors, it promises higher yields than like traditional bonds. So on the surface, it looks like a win-win, but underneath, that's where things get a little bit more complicated. Okay. On the point two, here's where the cracks start to show a little bit. First, you have lack of transparency. Unlike public markets, private credit deals aren't widely disclosed. They're not really talked about like that. That means less visibility into how risky these loans really are. Investors are often rely on internal valuations rather than market pricing, which can mask losses. Second point, rising interest rates. Many private credit loans are floating rates. That means as interest rates go up, so do the borrowing costs, okay? For heavily indebted companies, this is quickly becoming unsustainable. You can't last like this. As a business that could afford it, its debt at 3% might struggle or fail at like 8%. Third reason, credit quality concerns, okay? Private lenders often work with companies that traditional banks consider too risky to work with. All right, that includes your highly leveraged firms, businesses with an unstable cash flow, companies already near financial distress. In good times, that risk is manageable, right? But if the economy slows down, defaults could spike. And I think you're starting to see a lot of that in today's economy, okay? So the fourth thing we have is liquidity risk. Private credit investments are not easy to sell. There's no active market like stocks or bonds, right? So if investors suddenly want their money back, firms may struggle to meet those demands. This creates a dangerous kind of mismatch, okay? Long-term liquid loans funded by investors who expect quicker access to cash. You know, I know all of this probably sounds familiar, or you're starting to kind of notice that in what's going on in today's market. It's a dynamic that has caused problems in the past financial crisis, and you're going to see a lot more of it as we continue in our economy. Quick pause, guys. If you want more breakdowns like this that helps you understand economics, hit the like, share this with somebody who's into this kind of content, and subscribe. Most people don't learn this kind of stuff, so if you do, you're already ahead of the curve. All right, let's get back into it. Number 3, why this matters for our economy. So what happens if private credit starts to unravel, okay? At first, the impact might seem contained. It might seem like we have it under wraps, right? But the connections run a lot deeper than they appear. Private credit is heavily tied to private equity. Many buyouts rely on this type of financing. If lending tightens, it becomes harder to, 1, fund new deals, 2, support existing companies, and 3, refinance that old debt or some old debt. That triggers in itself a chain reaction. You got companies that default, investors take losses, lending slows down even further, and eventually it spills into the overall economy, the broader market. Okay, businesses start to cut jobs, investment slows, growth weakens. There's also a psychological effect that happens also. Financial markets are built on confidence. If investors start questioning the stability of private credit, that fear can spread pretty quickly. We've seen similar patterns before where risk builds quietly in less regulated corners of the system until it suddenly isn't quiet no more. Suddenly it's loud and businesses are going out of business. All right? So private credit isn't inherently bad. It isn't inherently bad, okay? In many ways, it's filled an important gap in our financial system, but rapid growth combined with low transparency and rising economic pressure, it creates a setup that's worth watching really closely, all right? The big question isn't whether there's risk, it's how much and where and when it's gonna show up first, all right? So those are some takeaways from private credit. I hope I was able to explain that pretty well. If you found this helpful, make sure to like, subscribe, and drop a comment. What do you think about private credit? As always, this is Evanomics, your #1 source for everything econ. I appreciate you tuning in. Check out some of the previous videos, and I always have more videos coming. I will see you next time. Thank you.